I've spent the past 24 hours going through analyst reports, macro research, institutional briefings, everything I could get my hands on. And one data point keeps jumping off the page. Global uncertainty has just broken every record we've ever seen. Higher than during COVID, higher than the 2008 financial crisis, higher than immediately after 9/11, and it's not even close. At the same time, capital is moving between sectors and industries at a pace we haven't witnessed in decades. Massive rotations, rapid reallocations, quiet repositioning. Most retail investors have absolutely no idea where that money is going. I wasn't even planning to make this video. I'm on holiday. I'm literally standing in a hotel lobby waiting to be picked up to go play tennis. But I had to record this because if you don't understand what's happening right now, your portfolio is exposed. It's vulnerable. It's sitting in the wrong place while institutional capital is already shifting. By the end of this, I'm going to give you the exact framework institutions use during periods like this. The same decision process, the same positioning logic, step by step, so you can protect yourself and potentially profit during the chaos. Let's start with what's actually happening. The World Uncertainty Index, which measures how frequently the word uncertainty appears in economic and policy reports, just hit the highest reading in more than 30 years. It spiked during COVID. It spiked during 2008. It spiked after September 11th and during the Iraq War. What we're seeing now is materially higher. And here's what makes this environment different. This isn't one isolated shock. It's everything happening at once. There's tariff-driven trade policy instability. Businesses can't plan because the rules keep shifting week to week. Oil prices surged due to geopolitical disruptions involving Iran. Brent crude pushed toward $126 per barrel. That's not just a headline number. That filters into transportation, manufacturing, logistics, food production. It's embedded in everything. The US dollar has weakened significantly. Even mainstream media is covering it. Gold, historically the ultimate fear hedge, has surged beyond $5,000 per ounce for the first time ever. Inflation remains stubborn. The OECD projects US inflation around 4.2%. That's not minor. That's structurally sticky. The Federal Reserve is boxed in. They can't cut aggressively because inflation is elevated. They can't hike meaningfully because growth is slowing. Global growth is weaker than pre-COVID levels. There's less cushion, less room for error. And yet, the S&P 500 sits near record highs, depending on the latest geopolitical headline. That divergence does not historically last. Something eventually reconciles. Now here's where this becomes personal for you. When uncertainty spikes like this, retail investors almost always make one of three catastrophic mistakes. Every single cycle. And I want to make sure you're not making them. Mistake 1, the cash panic. You sell everything. You go to cash. It feels safe. Your brain screams, protect what you've built. But if inflation is running at 4%, your cash is losing 4% per year in purchasing power. Guaranteed erosion. Historically, markets are higher 1 year after major geopolitical shocks roughly 70% of the time. Those who panic sell often lock in losses and miss the recovery. It's the most expensive way to play it safe. Mistake 2, paralysis. You do nothing. Not strategically, emotionally. You freeze. You avoid logging into your brokerage account. You hope it passes. That's different from having a long-term plan and sticking to it. This is avoidance. Your portfolio was built for a different macro environment. That environment has shifted. If you don't reassess exposure, you're effectively driving with your eyes closed. Mistake 3, chasing the spike. Gold jumps 60%. You buy gold at the top. Oil spikes. You pile into energy. Defense stocks surge. You chase momentum. Historically, the first spike in a crisis is often driven by fear and algorithms, not fundamentals. Those initial moves frequently retrace. Retail buys the peak. Institutions were positioned before the spike. That difference matters. Institutions don't react to chaos. They prepare for it. They understand sector rotation. They study capital flows. They reposition based on where money is going next, not where it just went. This isn't about predicting the outcome of AU.S. Iran conflict. It's not about guessing geopolitical headlines. It's about understanding the framework of how money moves. Because the stock market isn't one giant pile of stocks. It's segmented into roughly 150 industries. Capital rotates between them: aerospace, defense, oil and gas, energy infrastructure, software, biotech, consumer staples, utilities, semiconductors, logistics, cybersecurity. When you understand how money rotates between industries, you stop guessing. Now let me walk you through the four-phase framework institutions use during major disruptions. This pattern repeats whether it's war, trade conflict, energy shock, or pandemic. Phase 1, the shock. This is the first few days or weeks after a major event. Fear dominates. Algorithms drive flows. The S&P might drop 5 to 7% in 10 days. The volatility index spikes, sometimes dramatically. Gold jumps 8 to 12%. Defense stocks surge. Retail panics here. Phase 2, repricing. Institutions begin asking better questions. How long will this last? What's the structural impact? What does this mean for inflation? What will the Fed do? How are supply chains affected? Markets often bottom roughly 3 weeks after a shock and begin recovering within 1 to 2 months. This is where institutions quietly reposition. Phase 3, rotation. This is where informed investors make money. Capital flows into structural winners of the new environment. This phase can last quarters or years. Retail often misses it because they sold earlier or they're still frozen. Markets historically average 8 to 10% annual returns long term. But not all sectors lead equally. Certain industries dominate recoveries. Money doesn't leave the market. It moves within it. Think of it like pushing down one side of a swimming pool. Water rises somewhere else. So where does capital typically go during disruptions like this? Energy is often first. But the longer-term winners aren't always oil producers. It's often infrastructure, pipelines, storage, refiners. Defense sees immediate spikes, often 40% historically during wars. But institutions look deeper: component suppliers, AI defense systems, drone technology. Defense spending tends to remain elevated long after conflicts end. Gold benefits from central bank buying and a weakening dollar. But don't just think bullion. Think miners, streaming companies, ETFs, the ecosystem, consumer staples, boring but resilient. Food, beverages, household goods. Companies that can raise prices in inflationary environments. What struggles? Utilities and real estate often suffer in high inflation environments. Nice to have discretionary companies weaken as consumers pull back. Airlines face fuel pressure. Import-heavy businesses struggle. Now let's talk about the dollar. Step 3 of the framework. The dollar isn't just currency. It's the global reserve anchor. The dollar index has fallen. Central banks are diversifying away from pure dollar reserves toward gold and other assets. A weaker dollar typically means gold and commodities rise. U.S. multinationals benefit from overseas earnings conversion. Emerging markets improve because their dollar-denominated debt becomes relatively cheaper. But inflation pressure increases because imports cost more. If you're 100% in domestic dollar assets, you're exposed to currency erosion. Currency is a major macro signal. When the dollar moves, assets globally reprice. Now step 4, the institutional checklist. Before buying or selling, institutions ask discipline questions. First, what phase are we in? Shock, repricing, or rotation? Strategy differs in each phase. Second, where is oil headed? Oil impacts everything. It's embedded in global production. Third, what is inflation doing? And what will the Fed likely do? Higher inflation means higher rates, challenging for growth stocks and real estate. Lower rates support growth sectors. Fourth, what is the dollar signaling? Weak dollar, favorable for hard assets and global exposure. Fifth, what is the earnings impact? Stock prices eventually follow profits. Which industries benefit structurally? Which see margin compression? Airlines, likely pressured. Energy infrastructure, possibly supported. Defense systems, possibly supported. Sixth, what is the market not pricing yet? If everyone is focused on oil and gold, what overlooked sectors are quietly benefiting? Electronic components, waste management, cybersecurity, logistics. Institutions often make money by identifying under-discussed beneficiaries. Seventh, what is your time horizon? Are you trading this week or positioning for the next decade? Short-term traders play volatility phases. Long-term investors focus on structural rotation. Let me give you historical examples. Russia, Ukraine, February 2022. The S&P dropped roughly 8%. Energy surged. Retail panicked. 12 months later, the broader market had recovered significantly, roughly 60% higher from conflict lows. But the leaders were not evenly distributed. Energy infrastructure, defense, agriculture outperformed. After September 11th, markets dropped about 11%. Months later, recovery began. The longer-term rotation was into defense, surveillance, cybersecurity, sectors supported by sustained government spending. Institutions understand this playbook. Now you do too. We are in one of the most uncertain macro environments on record. That's data. But uncertainty doesn't equal guaranteed loss. Panic creates mispricing. Mispricing creates opportunity. If you understand capital flow patterns, don't move entirely to cash. Don't freeze. Don't chase spikes blindly. Have a framework. Have a checklist. Ask structured questions. You don't need to be on Wall Street. You need discipline. Markets are volatile at the open, but informed investors are positioned before the open. Money moves in patterns. Once you understand those patterns, you can respond rationally instead of emotionally. There is an invisible system influencing nearly every trade globally. Not just supply and demand. Not just central banks. Capital flows. Understand those, and you stop reacting. You start positioning.